Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening. This is a Q&A webinar, so I will be answering your questions. I've received a number of them prior, and we will get to anything that you ask during the presentation. So let's go ahead and get started. First, with a bit of information about STC. We are a retirement plan administrator only, so we do not provide legal, tax, or investment advice for our clients. We also are not a registered investment advisor, and we don't recommend, represent, or sell securities or investments of any kind. We don't endorse any particular investment opportunities that I might talk about during this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts, investment options that are available to you when you have a self-directed account, guidelines that must be followed in all retirement account investing, the retirement account LLC structure that STC uses for each of our clients, our particular services, and then I'll answer the questions. So first, to get started, I do want to define what we mean when we use the term self-directed retirement plan. And what we mean is that you may choose in a self-directed retirement plan any type of asset that is allowable by law, by the regulations. So that would include what some consider non-traditional assets like real estate. Self-direction also means that you manage your retirement plan's investments. So you're going to make the decisions related to the investments, buy, sell, improve, whatever your investments are. You basically have control. So that is what we mean when we use that terminology. And you are working with a company that permits you to self-direct. Now, there are a number of different types of retirement plans, and I brought out two to your screen, a traditional IRA and a Roth IRA. These are similar in that they have identical maximum annual contribution amounts that you can contribute into these plans from earned income. So for 2023, the amounts actually did increase over 2022. For 2023, you can contribute to each of these plans $6,500 from your earned income. If you are 50 years or older, you can add an additional $1,000 for a maximum of $7,500. The big difference between these two plans is whether the contributions are pre or post-tax. So with a traditional IRA, your contribution is pre-tax, and that means that you don't pay taxes on the contribution. It's deducted from your taxable income, and you will pay taxes when you begin taking distributions from that traditional IRA account. A Roth IRA contributions are different. They are post-tax. So you do pay taxes on the amount that you contribute to a Roth in the year that you earn those funds. However, with a Roth account, once that account has been open 60 months, 5 years, and you begin taking qualified distributions from a Roth, those distributions are not included in taxable income. So that means that monies that you put into a Roth and then earn, all the earnings on the monies in a Roth account, if they are taken as a qualified distribution, they are taken without having paid any taxes on them. So that is a distinct advantage of a Roth IRA account. There is the opportunity for tax-free earning in a retirement account. A SEP account is a simplified employee pension plan. Some sole proprietors, small business owners have this type of a plan. The maximum contribution to a SEP also increased in 2023 up to a maximum of $66,000. I have a business, I have a SEP on my business. So from the earnings that I earn in that business, I can make a contribution into my SEP plan. A simple plan is a savings incentive match plan. I've seen this used in partnerships, also in sole proprietors. It has some different requirements and different language for the plan. It also had its annual contribution amounts increased for 2023 up to $15,500, or if you're 50 or older, $19,000. So this would be on a business earnings that you have coming in, then you could make a contribution from those earnings. I brought out onto your screen 4 plans that all say former employer. So 401k is a for-profit corporate type of plan. 403b, often used by nonprofits or charitable organizations. TSA is tax sheltered annuity, and a TSP is a thrift savings plan. Now, if you formerly worked for an employer and have participated in one of these types of plans, then you can move the money out of that plan into a plan that you qualify for, say a traditional IRA. And then if you chose, you could work with a self-directed company like STC, and you could self-direct those monies. If you are currently working and participating in one of these types of plans, then you will need to go to your plan administrator and ask if you are eligible to move any funds out of their plan into a plan that you qualify for that you might be able to self-direct. A solo 401k is a newer type of plan, although now it's been around for some time. It is a nice plan in that it was developed for sole proprietors to give them similar advantages to people who can contribute to a 401k. So if you are a sole proprietor, basically working in business by yourself, by yourself, a spouse can be involved, but basically no or very, very limited employees, you could consider a solo 401k plan. Some of its advantages are, of course, you can make both an employer and an employee contribution because you are both as a sole proprietor. You also have the opportunity to set up a Roth provision in a solo 401k, so you could be making Roth contributions and have that tax-free earning potential. You can also set up a loan provision in a solo 401k, which can be an advantage for a small business owner. The loan can be used for any purposes, doesn't have to be for the business purposes, as long as it's paid back according to the terms, time, and interest that are set up in the loan provision in the plan document. So you will want to check with your accountant if you want to see if you're eligible for one or more of these plans that you don't currently have. So just some basics about those plans and the possibility of self-directing in these plans. Now, with a self-directed retirement account and working with a company that permits any allowable asset, you do have a lot of investment options. So, of course, you have the option of real estate. And there are a number of different types of real estate that you might consider. You could invest, your retirement account could invest in single or multifamily homes. You could invest in the vacation investment property. Let me give you one caveat though. If your retirement account does own a vacation property, you personally cannot use that property because of the rules related to disqualified persons. So it truly does need to be an investment property that you are not personally using. Tax liens, another type of investment related to taxes on real estate. Raw land, building lots, commercial buildings, real estate syndications. So that might be where an investor puts together a group of investors to invest in a syndication, perhaps something like a commercial property that individual investors might not have sufficient funds in their retirement accounts. But when you pool them together, then as a group, you could invest in a commercial property. So a real estate syndication. Mortgages, loans, you can actually lend money from your retirement account to someone. You can set up the terms of the loan. Could be promissory note, could be maybe a loan to a business owner for profits from the business. So you can set up and determine the terms of the loans that your retirement account is making. Private business investments, you can actually invest in a business. Now, one thing to keep in mind here is that you cannot work for that business, or you can't even provide any service free for that business. It must be an arm's length transaction between you and that business investment in your retirement account. Certain precious metals are also permissible investments. The IRS has written and approved certain bullion and coins that can be owned in retirement accounts. The Forex market, foreign currency market, options, futures, all of these can be invested in. And of course, what you're probably most used to hearing about in retirement account assets, stocks, bonds, and mutual funds. So with a self-directed retirement account, you do have a very wide array of different types of investments. Most financial advisors believe that having diversity in your retirement portfolio is a very good thing. So something you might want to consider when you're looking at your retirement account investments. Now, with all retirement account investing, there are rules to follow. The IRS, ERISA rules apply to what you can and cannot do in a retirement account. So there are guidelines. There are some assets that are prohibited that you may not own in a retirement account. The first of these is a life insurance contract, with one exception. If you have a solo 401k, then a life insurance contract is a permissible asset in your solo 401k. But in other types of accounts, a traditional IRA, a Roth IRA, you may not own a life insurance contract. In addition, collectibles are also prohibited assets. Rugs, works of art, stamp collections, coin collections. So these coins are different than the approved precious metal coins that are permitted. We're talking here about coin collections, something that might have great value, but you can't own it in a retirement account. I'm guessing a wine collection would also be considered a collectible. So those types of things are prohibited assets and may not be owned in your retirement account. There are also prohibited transactions, things that you may not do because they violate the rules related to retirement accounts. So first off, transactions that are not for the exclusive benefit of the plan. Your retirement plan is given a tax preferential treatment. It's not taxed until you begin taking qualified distributions or begin taking distributions. So the whole purpose of your retirement plan is to provide you income when you retire. So as you are building your retirement wealth, the transactions that you engage in your retirement plan do need to be for the purpose of benefiting that plan, growing your plan's wealth. You cannot personally borrow from your retirement plan. You also cannot pledge your plan assets to secure a personal loan. Now, I have spoken with someone who had a loan application, a personal loan application, and it asked them to list their retirement plan assets. And there's not a problem with that as long as the retirement plan assets don't serve as collateral for that personal loan. They cannot do that. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. So let me just expand on that a little bit. Your retirement account can get a loan to purchase real estate. It's called a non-qualified, it's called, it's a certain type of loan. It does have to be more like a commercial loan because obviously your retirement account does not have a job. It's not a person. So it does have to be a loan that is not personally guaranteed. But your retirement plan can get a loan. and it's a non-recourse loan. That means that the lender has no recourse other than the property that the loan is on in the event of a default. So no other recourse, a non-recourse loan. So you cannot utilize your personal credit or guarantee to obtain a loan for your retirement account. Your retirement account can go out and get a non-recourse loan, but you can't personally guarantee it. You also cannot benefit any disqualified person with a transaction that your retirement account engages in. So let's talk a little bit more about who disqualified persons are to help explain this. You are a disqualified person to your retirement account. Two separate entities, you personally and your retirement account. So let me give you an example. Let's say you personally own a vacation rental property in Myrtle Beach. Your retirement account cannot purchase that rental property from you. That would violate this rule. And if you're married, this also includes your spouse. Your retirement account could not purchase a property owned by your spouse. There are other family members who are also disqualified. Ascendants, so that would be your parents, your grandparents, your great-grandparents, on up the line, and your descendants, your children, your grandchildren, your great-grandchildren, on down the line. Ascendants and descendants are disqualified persons to your retirement account. However, lateral family members are not disqualified. So that would be brothers and sisters, aunts and uncles, nieces and nephews, first, second, 12th cousins. They are not disqualified. So let's go back to that Myrtle Beach vacation property. If your father owned it, he's an ascendant, so your retirement account could not purchase it from your father. If your daughter owned it, she's a descendant, so your retirement account could not purchase it from her. However, if your sister owned it or your uncle owned it, your retirement account could purchase it from them because they are not disqualified. So just some things to think about when you're considering transactions and who you might be purchasing from. There are also some entities that are disqualified persons to your retirement account. Any company, if you are a majority shareholder, that company is a disqualified person to your retirement account. Also, any company, if you're an officer, a director, or a highly compensated employee of that company is a disqualified person to your retirement account. I often talk to real estate investors who run their businesses through a real estate investing company. It could be an LLC, could be an S Corp, and they ask me, if my company owns a property, can my retirement account purchase it from my real estate company? And the first question is, are you a majority shareholder? If the answer is yes, then no, your retirement account cannot purchase it from your company. If they say, well, I'm not a majority shareholder, I am less than a majority, then the question is, are you an officer? Are you a director? If the answer is yes to any of those, then that company is still a disqualified person to your retirement account. So some things to consider, again, when you're thinking about investments. Now, STC uses a particular type of account setup for each of our clients' accounts. And it is an LLC. It is a specialized type of LLC. Its operating agreement and its articles of incorporation are designed specifically for it to be owned by a retirement account. So it is a specialized LLC that our operating department sets up for your account. And the reason that we use this structure is because it has a number of benefits for our clients. One of the primary benefits is it gives you maximum flexibility in structuring transactions. So let's just consider a transaction, a complex transaction that you might want to engage in. Let's say you want to partner with your spouse's retirement account, get a non-recourse loan, and purchase a rental property in a college town. So when you have this type of structure, it will make that partnership straightforward. You can do that type of thing as long as it's structured properly. You may want to get a loan, and let's say when you buy that property, you need to do some repairs. So you're going to have to hire a general contractor. So just having this structure gives you a lot of flexibility in structuring complex transactions. It does provide an additional layer of asset protection. I mean, it is a limited liability company, so it does protect against other assets being used to satisfy a debt. It does give you checkbook control over your retirement funds, which means you have immediate response to investment opportunity. I was just looking at some real estate that is for sale in my neighborhood, and still the market is very hot here, and houses go on the market and they're sold within a week. So you may have to move very quickly when you find an investment that you want for your retirement account. And having this checkbook control can be very important. Now you'll notice that I have checkbook control in quotes, and that is because at STC, we don't actually give you, the client, the checkbook for your retirement account. And we do that really as a form of protection. You may not know all the rules that relate to a particular type of investment or all of the ramifications of different regulations. So what we do is we review your transaction immediately as soon as you send us the documents, and then we can make sure that you're not violating any of those rules that I talked about, and then we can same day or next business day fund that transaction. So really what you have is what I call protected checkbook control. You have the ability to move quickly on a transaction, but you have our experts in our client services department reviewing your transaction to make sure that it complies with all the IRS regulations. This does, the LLC also does simplify asset titling. If you are interested in real estate investment in your retirement account, you can actually go to the closing on behalf of your retirement account and sign the closing documents. You don't have to have them sent to our corporate office where they might languish in someone's inbox who's out on vacation until they get back. Rather, you can go to closing, sign the documents, and then you send us copies and you can keep the original documents. So it does simplify asset titling, purchasing real estate, and transferring title of that real estate. And this structure does also ease pooling or partnering with other funding sources to co-own an investment. Your retirement account does not have to wholly own, wholly fund an investment. You can partner with other funding sources. And in fact, I'm going to show you on the next slide how you can even partner at the inception of the purchase transaction with otherwise disqualified parties. So let's look at this schematic of the account structure set up with STC. So you'll see on the upper left, we have your current custodian where your money is currently held. You decide you want to open a self-directed account with STC. So you complete paperwork that directs your custodian to transfer or roll over funds to our custodian. You also sign documents that tell our operation department to set up an LLC in the state of your choice, and we set that up for you. Once the funds have been received by our custodian, then the funds move to a bank account that your LLC has access to, and the membership interest of the LLC is held by the custodian. So now, once that process is complete, you are ready to begin your investing. Now, in this case, your retirement plan has 3 investments. Investment number 1 and investment number 2 are wholly owned by your retirement company, your retirement plan. Let's say one is a tax lien and you have a brokerage account. Number 2 is a brokerage account where you are actively trading stocks and bonds and mutual funds. Investment number 3, we'll say, is a piece of real estate. It's a rental property. But you'll notice that your retirement account is one of 4 investors. Investor number 1 is your father. Investor number 2 is your daughter. And investor number 3 is some personal money that you had available. Now, you remember I told you that your ascendants, your descendants, and you yourself were all disqualified persons to your retirement account. So how does this work? How is this a viable transaction? You'll notice in the yellow box at the bottom, as long as you co-invest your father, your daughter, your personal money, and your retirement account at the inception of the purchase transaction, then this is a permissible transaction. So we have many folks come to us, say a husband and a wife who want to co-invest their retirement money in something, maybe a property. So that is doable, and we can help you structure that properly so that it is a viable transaction. Now, before I get to the Q&A section, I do want to tell you what STC does. We are a full-service, self-directed retirement account administrator. That's all we do. And so these are the services that we offer. We offer that LLC structure setup that I just described for you. We offer you that protected checkbook control, so you have our client service experts looking over your transactions, but also same day or next business day funding them. We have CPAs and attorneys to answer any difficult technical questions you may have. We offer really unlimited guidance on transaction compliance. So you don't have to wait until you're ready to purchase something to talk with our client services department. You can get in touch with them and discuss a transaction that you're considering, who you're purchasing from, what it is, and they can help you understand if that is a transaction that is in compliance with the IRS rules. So you can get unlimited guidance on that. We also handle all of the back office support. So every year, a valuation needs to be done for your account, and that annual valuation needs to be reported. So we're going to maintain financial statements for your LLC, a balance sheet, statement of cash flows. We will have those documents available for you quarterly, so you can really run your retirement account like a business, and you can have access to that information online. We're supervising the regulatory reporting that's required, and we will oversee that annual valuation. So our focus as an administrator is to take care of all of the administrative back office compliance stuff so that you can focus your efforts on finding the best investments for your retirement account. And then we can help you transact those investments once you have found them and they are compliant with the rules. So that is what we offer our clients. Now, I do want to open the floor for Q&A. So please, if you haven't already, type your questions into the question box on your screen. And while you are finishing that up, I do just want to mention a couple of things. You know, we want to help you however we can help you. So you may know that you want to open a self-directed account now, and we can get you that paperwork to get you started. You may have clients or colleagues who might be interested in self-direction, and we're happy to communicate with them or through you with them. Or you simply may need more information about what you can do, what you might be interested in doing. So on your screen now, you have our contact information. We do have a website, stcira.com, that has a great deal of information there, and also some client information so that you can see some of what some of our clients have done and been able to accomplish in their retirement account. Our corporate number is on the screen, and my company email is there as well, so you can get in touch with us anytime that you are interested. So let's go back and open the floor to our questions. And I did receive a few in advance. So let me pull these out while I look at what you are typing to me. So one moment, please. Okay. Okay, so first question. What is the time frame to get my account up and running with STC? Okay, typically it takes 4 to 6 weeks from the time that we receive the original paperwork. Now, the reason for that timing is we do need to get the money moved from your current custodian to our custodian. And that is a process that we don't have control over. You're going to complete documents and submit them to your custodian, and then they are going to go through whatever process they go through to move that money to our custodian. So that's piece number one. Also, we need the time to set up your LLC. And depending on what state you want that set up in, we work very diligently to get that done quickly, but we are also at the mercy of the state and corporation, whatever state you choose. So those are a couple of things we cannot control. We can control our part. Then, once the money is moved to our custodian and the state of your choice has created your LLC, then the process is really straightforward. Money moves to a bank account, and then you're ready to start investing. So what we do, our operations department will keep you informed of each of these steps. We'll tell you when we receive the funds, we'll tell you when the incorporation of your LLC is complete, and then we'll tell you when your account is funded and you're ready to invest. And you'll get that information via emails, and then you will also get information in the mail, a binder with all of your setup documents, the process for making additional contributions to your account, the process for investing, the process for taking distributions. All of that will be included in that information. So we do ask for 4 to 6 weeks. It often does not take that long, but if you are interested and you're already looking at investments that you might want to consider, please do get started on your paperwork right away so that we can be ready for you when you find that investment. Okay. Okay, I sort of answered this question, but I will answer it again. Can I use my IRA funds to make an investment with my spouse? So again, typically the answer would be no. Your IRA is prohibited from engaging in transactions with your spouse or your spouse's IRA. However, if we structure that investment properly, you can invest with otherwise prohibited parties at the inception of the transaction. So what we do is we encourage you to call us and discuss these types of transactions in the early stages, and then we can give you the information that you need to make sure you're heading down the road in the right direction and not the wrong direction. Okay. Let's see. Okay, so this is sort of an add-on question. I want to start investing in real estate, but I don't have enough in my IRA to buy a property outright. Do I have any other options? Yes, well, a couple. Again, you could partner with another individual that has funds that they would like to invest. So that would be that co-ownership. And when we talked about that in our schematic, how you could actually even do that with otherwise disqualified persons. The other option is that non-recourse loan option. Your retirement account could borrow funds to complete the transaction. Now, that can have tax implications of UDFI, unrelated debt financed income. I won't go into detail about that. It's a kind of a complex topic, but it certainly is an opportunity that you can take if you would like to invest in real estate but have insufficient funds. If I want to put money into an IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. You can open a brokerage account. I referred to that with any company that you choose. A couple of things you have to keep in mind, though. The account must be opened as a business account in the name of your IRA LLC. So our customer client services department can help you with that. And we do request that you send us copies of your monthly statements to ensure that you're not making any deposits or taking any withdrawals out of that account personally, because again, it has to go through your retirement account. So let's say you would make a contribution to your retirement account, then you would direct us to send monies from your retirement account to the broker the stock brokerage firm that you're choosing. We would send that. They would open that business brokerage account for you. You would have access. You would do trading. You decide you want to sell something, the monies, and take money out. Then that money has to go back into your retirement account. So and then if you wanted to take a distribution and you were eligible to, you could take a distribution from your retirement account. I know some clients use that type of an investment to earn income on money that's cash money in their account while they're looking for another investment. Let's say they own a real estate piece of real estate, rental property, they sell it. Now they've got $200,000 cash that came back into their retirement account. While they are looking for their next investment, they take that $200,000, move it into a brokerage account, actively trade it. Then they find the investment they want. They liquidate those assets in the brokerage account. The money moves back into their retirement account, and now they can fund a new real estate purchase. So that's how you might use a brokerage account in your IRA account. Okay, this is a multi-part question, so let me read it and then I'll break it down. A traditional IRA requires the owner to begin withdrawals at age 72 actually it might be 73 now. I think that just changed recently. But you do have to begin taking required minimum distributions. If you own real estate if one owns real estate in their account, is it required to sell it at some point in time? And I'm assuming that means in order to take the required minimum distribution. If income from the property exceeds the allowable contribution, how is that handled? Okay, that's a second question. I'm going to come back to that. Okay, so if you own real estate in your account and you are required to take a minimum distribution and you have insufficient cash to do that, you are not required to sell that property, but what you can actually do is take the value of the house or a portion of the value of the house or property as the distribution. So what that would mean is an updated appraisal can be done on the property, and the property would need to be retitled in the account owner's personal name. So if only a portion of it is being distributed, then it would have two owners, your retirement account and now you personally, in whatever proportion that required minimum distribution was. And let's say it was a rental property. If now it's co-owned partially by you and partially by your retirement account, then any income and any expenses needs to be proportionate to the new ownership value. But you do not have to sell the property in order to take a required minimum distribution. So we can help you and walk you through how that would happen. Now, the second part of this question is, if income from the property exceeds the allowable contribution, how is that handled? I want to clear up something. I've had this question a few times. Income from investments in your retirement account is unlimited. You can earn as much as possible in your retirement account. That's completely different from contributions. Contributions are limited. What money you can put into your retirement account from your earnings each year is limited. But how much the money in your account earns is unlimited. So those are two different things. And each year the IRS publishes the annual contribution allowances, how much you can contribute from your earnings. And so that's a set number every year. But how much your investments earn, that is unlimited. And while I'm on that topic, I do often get a question, and I think I might have had one even here. Yes, I did. Do I have to have earned income in order to contribute to my IRA? Does money earned from rental income qualify? So the answer is yes, you do have to have earned income. And income from passive investments is not considered earned income. So let me just describe what earned income is according to the IRS. Taxable earned income includes wages, salaries, tips, and other taxable employee pay. Can also include union strike benefits, long-term disability benefits, net earnings from self-employment. Those are earned income. Examples of income that are not earned income: interest and dividends, retirement income, Social Security, unemployment benefits, alimony, child support. None of those are considered earned income, so you can't make a contribution from those funds. So I hope that helps. Okay. Can I provide startup capital for a new business, such as a retail clothing operation or an auto repair shop? Yes, the answer should be yes, as long as it's not a disqualified person who owns or works for that retail clothing operation or an auto repair shop. So you can't help out an ascendant or a descendant, but you could help out a sibling by providing startup capital. One thing, again, you will want to keep in mind, if you are investing in a business, you will want to talk with your accountant about UBIT, which is unrelated business income tax. That could possibly come into play with this type of investment. So I'll just leave it at that. Something that you would want to consider. But yes, it should be, as long as you're not dealing with a disqualified person, that should be fine. Are in-laws prohibited to loan money to? So when I talked about disqualified persons, and then I said that you could make a loan from your retirement account, and I said that disqualified persons included your spouse, and we would say it also includes your in-laws, so your spouse's parents. We do believe that is a prohibited transaction. Okay, let's see. I'm just reading through some of these questions I have answered some of them. Can you purchase additional interest in a property you are already invested in? Okay, so I'm assuming you are already invested in that personally. That's how I'm interpreting this question. And then the answer would be no, because you personally own it. Now let me just qualify that. If this is an investment that's wholly owned by your retirement account, maybe it was some kind of a real estate syndication, and you invested $10,000, and now that syndication is offering you another opportunity to invest more if that would be okay then. That's not dealing with a disqualified person, because when you made the first investment, that would have been determined already. Okay, so another question. So all current IRA, CDs, 401k IRAs can be rolled over to, oh, that's a question. Can they? I read that you can only roll over once per year. Is that per account? Okay, I have had some questions about rollovers versus transfers. So first, let me define what a transfer is. A transfer is moving money from one custodian to another custodian. So let's say you have retired and you had participated in a 401k, and you've got money in that 401k, but you don't work at that company anymore. So you can go to your administrator, and they can request the custodian to transfer money from their custodian over to a new custodian directly. So you could do that directly with STC. The money would go from your current custodian directly to our custodian. That's considered a transfer. That's not even a reportable event to the IRS. A rollover is different. A rollover is when you receive a check from your custodian, and then you have 60 days to get that money into a new account that you qualify for. That is rolling money over. Now, in recent years, there has been a change to the law, and now you can do one rollover a year, no matter how many accounts you have. It used to be that people were rolling over once from multiple accounts, so multiple rollovers. But now it's one rollover no matter how many accounts you have in a year. So again, a rollover, you're receiving the money, and then you've got 60 days to get it into a retirement account that you qualify for. And if you don't get that in deposited, then it has become a distribution to you, and likely a taxable distribution. So rollovers, you want to be, very aware of what's happening. If you get that money personally, you need to make sure you've got a plan to get it back into a retirement account within 60 days, or you will have a reportable distribution that will be taxable. Okay, let me look at my time. Okay, I've got time for 2 more questions. Can I buy my sister's house and rent it back to her for less than her mortgage payment? Okay, so a couple of things. Obviously, you can buy real estate, so you could buy a house. Your sister is not a disqualified person. She's a lateral family, so you could buy it from your sister and now rent it back to her for less than her mortgage. The answer is yes, you can do that. You will want to consider that this rental rate is a fair market value. Like, you don't want to rent it to her for $20 a month or something, because the IRS, if they, looked at your account, they did an audit, they would there'd be a big red flag, and they would probably consider that you didn't engage in that transaction for the exclusive benefit of your retirement account. Because $20 is not very much rental income. So you can do that transaction, but you'll want to be aware that the rental rate you charge your sister, your family member, is fair market value, close to that. Okay, one last question. I have 2 side businesses. Can I do a SEP for each, and what is the maximum total allowable contribution? So you should, if you have 2 businesses, you should be able to do a SEP for each one and make contributions into each one for each business. So again, the contributions, that maximum amount, I believe I said that was $66,000 for this year. So $66,000, you'd have to have that much in earnings in order to be able to contribute it. But that should not be a problem if you have 2 SEPs. Well, I do appreciate you joining me for tonight's webinar. I hope that you will be back next month for our educational webinar on a variety of different types of investment possibilities that are available to you. Please do get in touch. Check out our website, stcira.com, if we can be of help to you. I would love to hear from you and give you assistance. Thank you. Good evening.